Not since 1995 have we seen a day in stock markets quite like this, and as traders and investors, we need to be paying attention. The worst sell-off since 2022 and $1.7 trillion of value erased in 2 weeks has led on to the MAGS ETF having the worst return ever of 6% in one session. Now, that means the Nasdaq is almost in correction phase, but really we should be paying more attention to what's underneath the hood. And in today's video, we'll talk about whether we can get mean reversion on the markets and whether the VIX is going to reach the magical 20 zone, marking that second big pullback that we expected in an election year. But there are also some other problems. Yield uninversion. Yes, it's starting to get to the lowest point that we've been in quite some time, and it marks the same area that we were at in October of last year. So what's really going on? Well, today we'll break down together what's happening on stocks, commodities, and cryptos, including some data that will absolutely blow your mind. Well, welcome back everybody to A Sea of Red. My name's Tom, and in today's video, we need to discuss, of course, what exactly just went on in markets. We've got some amazing data coming your way, but if it's your first time here, welcome to the channel. Remember to subscribe and smash that bell icon, especially if you want to know more about Wall Street, dark pool liquidity, and of course, how all of this works with options. So let's go back in a time machine for a moment together, and we're going to look at this great article posted over on X by Jason Gopfert that says technology stocks lead the market sell-off. Now, this basically was when we saw a 3% sell-off of NASDAQ stocks, but there was still more up volume throughout the session. And in fact, we ended up closing with 40% of stocks up, even though the market was overall down. Let's read a couple of lines here. Only a day after posting several records, the stock market fell sharply yesterday, in its biggest decline in nearly 9 weeks. The drop was attributed to, in some parts, to traders' concerns about technology stocks, especially Microsoft. These issues have been high flyers and have outpaced the overall market to reach record levels, but they could now be rising higher than their earnings warrant traders' fear. Does that sound familiar to 2024? Well, if you answered yes, then you'd probably be very correct. Of course, people are really concerned about semiconductors and the big stocks leading this thing. So it could be a bit of a shakeout. We've already seen Google's return, and that actually looked pretty good, I thought, in the earnings. Of course, we do expect a pullback from that point, but now we go into next week's big tech earnings with super negative sentiment. And for most of 2024, it's been pretty chill. In fact, you can see here on the chill index, we've only really had a few outliers, and in general, we haven't had really big sell-off days across the board on the S&P 500 for a very long time. So we're resetting all of that now, and we go back into some new stats. Here's a great one that Optima posted over on X, and I reshared this over on our Twitter X as well account. Links in the description down below if you want to follow along. And basically it states that when you see a 2% day down on the S&P 500, you usually, of course, would expect most stocks to be declining. Well, as it turns out, 165 stocks were actually making new highs, and they closed at highs throughout the session. And this is a record that we haven't really seen since 2020 when we got another good read. And can you guess when that was? Yep, if you guessed the March low, you would be correct. The last real thrust kind of level with a negative day came at that point. So it wasn't all bad across the board. It was like the most bullish bad day you've ever seen on markets. That's pretty much what happened through the last session. Also, when the NASDAQ composite goes down over 3%, Jason Gopfert overall posted that we've only ever seen it 2 times with NASDAQ up volume being over 40%. Now, one of those readings was 1995, and it ended up going into the bull bubble. The second one was right at the peak. But in both cases, 2 weeks, 1 month, and 2 months later, we were up. So really what it's telling us is that this dip, while it could keep dipping a little bit more over the next week, in general should be purchased up. And we get the same read when we look at a 300 sessions without an over 2% loss, and we start to look at the stats. 2 weeks, 1 month, 2 months later, pretty strong, especially 1 month later at an 82% read. And when we look at the thrust, and of course we look at the seasonality, it starts to get even more interesting. Just a few more trade days left in July, but if you're not familiar with this, did you know that over the last 10 years, we've never seen a July be negative for the Qs? In fact, we've got a 100% read with an average return of 4.9%. And at today's reading, it's down over 3% plus. And that basically means that we have to make up what we've just lost today, plus a little bit more, and we'd go back into keeping that stat alive. Now, that's just a stat, but it is something that's important to look at. Along with this really important fact, people are now starting to talk about this again, yield curve inversions. Now, we've got some data on what tends to happen when yield curves uninvert. But if you're not familiar with yield curve uninversion, this is one of the most important things. Generally speaking, it starts recessions. And of course, you can go up, down, and all around like you did back in the 70s, but it ended up being a recession. Or you can basically just see cuts that lead into significant weakness in the markets overall. Now, this is coming because, of course, the market is effectively cracking it and saying, we need rate cuts, we want them now. And that's why we're seeing a buy up of really small stocks, and we're seeing a little bit of a sell-off of the big stocks, even though realistically a rate cut helps them as well. 68 basis points are now being increased from 62 last week in terms of how many cuts we expect by January 2025, or at least the market's looking at. And you can see here, based on the Fed dot plot curve, that we're basically moving down to somewhere in 2026 to around 3.53% terminal rate. So that's basically how many cuts are expected by the market. You'll also notice that then upticks. So things have still got some strangeness on the long-term yield, and the expectations of more cuts is now advancing on what the Fed dot plot actually says. And of course, you can't really pay too much attention to the dot plot because they never stick to those plans regardless. So what will happen after we get a overall rate cut? Well, funnily enough, it's expected by the market that if it goes with, oh yeah, we're going to get a cutting cycle, it actually usually goes down. In most of these, average if recession, average with no recession, etc., what would happen is markets would pull back into the start of the rate cutting cycle, which many people believe is now being brought forward from September. And then we would get an uptick in the good cases, in 3 of the good cases, and further down ticking if we went straight into a recession. Now, I tend to be on the camp that believes that we'll get an uptick in markets after the first rate cut. So don't believe that uninversion of yield or even a rate cut will instantly crash the market. It generally happens quite a lot after that. Remember, people have to believe it doesn't work anymore. And what people will do is, as soon as we get a yield uninversion, everyone will say, oh, the market's got to crash right now. I'm here to tell you the data doesn't point towards that, and we'll talk about it more in the future on this channel, so make sure to subscribe for that. Another thing is we tend to be in a secular cyclical market of bullish kind of returns right now, and that's being kind of marked out by some of the other things that we've seen in markets recently. The performance of IWM, the Russell 2000, it started to uptick. We obviously saw it pull off its lows last year, and this kind of brings in to the idea that we're going to get rate cuts and that the Russell is possibly going to be the best returner over the next coming months. Why? Well, it's got to do with the fact that we usually see deregulation at the end of these cyclical events, and that tends to lead into an overall thrust, which is what we saw literally just a week and a half ago. Now, we know when we get these thrust readings, what happens? The markets tend to drop for the next 1 to 2 weeks, and then they'll often recover. And the Whaley breadth thrust is one of the best out there. So many reads, and I don't ever discount it because it has a 100% track record over the next 252 days. Very, very strong, but again, you'll notice 5 days, 10 days after, then 21 days after things change. Now, where are we right now? We're literally in between this zone here of trade days. So basically, if you think about it, all the stats are pointing towards at some point soon, the market getting some reprieve and probably going back to the bull end. Now, why could that also be true? Well, have a look here at Wall Street Horizon's EPS increase versus decrease chart. Things are improving. I mean, underneath the hood, the small cap companies, the ones that aren't the big kind of 7 stocks, they're actually increasing, and they're also increasing their dividends across the board as a percentage, which is pretty strong. Also, the IPO market has started to tick up again. Of course, it's nowhere near where it was in 2021, but it's starting to show some signs of life. And if that's the truth, and we do end up getting an IPO sign of life kind of coming back through, it's everything we've been discussing for a while here on the channel, which is that we should start to see AI IPOs start to come through, and that to continue maybe an AI bubble component. Now, of course, there are some problems. Number one is credit card delinquency rates starting to increase. And of course, the pressure of these high interest rates are really starting to be fed through when you're looking at some of the more risky credit markets, in particular credit cards, not so much mortgages. and car loans and delinquencies in general, we are starting to see them tick up. And that's not a great sign, of course, when you think about how many people are struggling out there. There are some other little reads that I thought I'd bring in as well. CrowdStrike's Bank of America report here from Mike Siccardi over on X basically says that if you focus on the fundamentals, CrowdStrike looks pretty good. And certainly I will be watching this stock for a dead cat bounce or basically a bit of a recovery soon. But of course, you must be patient to wait for that low and look for that turn. Another good sign for markets is that all the financials are making new 52-week highs, and they've continued to be relatively strong even over the last 24 hours. For their earnings kickoff the rest of the week, you can see here Thursday into Friday, still some big companies to come, and these are the expected options moves. So you can see there's still some volatility coming through. Now, did we expect volatility at this time of year? Well, the answer is kind of yes. We know that in election years, what's happening is that the VIX, or the volatility market, was expected to start kind of upticking back end of July into August, into September, possibly into October, November. So will we get more volatility to come? I would say most likely, because of course, usually you'll see the VIX over 20 during a corrective turn in markets, and we can usually expect 2 corrective turns. So I'd say that this looks like one based on the fact that the S&P 500 has broken underneath the key zone we'll look at in a moment. Now, another thing we saw was huge transactions just before that fall off of the market in the last 24 hours. We reported on this one yesterday, which was a huge VIX dark pool trade. Well, they'll be very happy with themselves because, of course, the VIX went ballistic up, and that is a great trade for them. And also, we've now started to see people buying back in. Well, I can only assume it's buying back in to the semiconductors. Semiconductors fell. They actually hit one of the key levels we've been looking at, which is the weekly 20 moving average. And we're starting to see a little bit of stacking. So while everyone else is freaking out in the market, if this market does turn to the upside now, this is a good sign. We're starting to see a bit of stacking of big volume, and we can obviously tell that someone was selling a little bit over here. So it looks like a bit of a cluster. We'll continue to update on this because if they keep clustering up, that's a great sign for buyers. We also saw some big trades coming through, another big dark pool trade. Maybe it's just the one that got closed, probably a sell. Maybe that's a overall, okay, let's close, get some profit, gap fill, etc. SPYG, basically just an S&P 500 growth ETF. So another big trade coming through. Now, it all comes back to where are we? Well, do we expect pullbacks? Yeah. Do we think they're normal? Absolutely. If we get over 15%, would we start getting a little bit worried? Well, it depends what's underneath the hood. But for now, we're basically in this track record, and you can see that we're most closely correlated at the moment with the 60s and 2000s. And both of those markets were heavily concentrated markets with just a few stocks doing really well. And it sounds familiar when you think about those reads that were both in the 95 area and of course just before the dot-com crash, where we see so many NASDAQ stocks still doing well while the overall market is selling off. So let's take a look at the market underneath the hood for the last 24 hours, and it was kind of what you would expect. Semis were down, technology was down, gold stocks were actually down a little bit more than you would think, and utilities was the number one out, and that is one of the most defensive markets. Healthcare also did okay, but I find this the telling factor. Both home builders and KRE, regional banks, still poking their head into the green, and that takes us to an overall read now over the last 5 days to utilities, solar, healthcare, biotech, and energy being on the positive end, and then realistically, the rest of the stocks being the main growth stocks down the bottom. Now, I do take a lot of solace in the fact that XLF and KRE haven't fallen off too much because this is very important. We don't want to see those stock markets falling because that basically says there's a significant weakness possibly in the debt market, and we must be looking for that, especially over the next year. Because if we see home builders, we see financials doing poorly, that's a huge warning sign, a massive red flag in the markets, even if everything looks super good. Let's have a look at the S&P 500 from a flow perspective. It was negative, as you would expect here on the charts, and it ended up closing below 54.40. Now, it did come into what I guess is the significant demand from this zone, because of course that's the demand. This is reacting off it. But still, that is a pretty negative overall close. And it tends to suggest that even if we do get rallies, which I kind of expect us to see maybe a dead cat bounce soon, that will probably go lower. And I think most notably here, we have a gap sitting around 53.75, we are now firmly in negative gamma zones. And funnily enough, 54.40 is a huge put zone that you'll see in a moment. And that is very important. If the market holds underneath 54.40 during the session, it could get slammed into 53.50 very easily. And the second zone I'm going to have is around 5300, which just so happens to line up incredibly well with the weekly 20 moving average. Now, this is going to be possibly a trend line trade, a moving average trade, a key level of demand trade, and of course a most traded zone as well on the way up. So there's so much going for 5300 should the market continue to fall down. And if it does just kind of smash straight into that and we don't see a structure build, then that would probably be a little bit easier in some ways to trade than what usually happens in these markets, which it goes down a bit, comes up a bit, goes down a bit, does all of the dance around those points. But for now, I think the correction could end around here based on the evidence that we have at hand. And it does look like it's shaking out specifically semiconductor stocks. If you want to have a look at where the one-day expected options moves are, they're here. And as always, we always say patience, react, don't predict. I posted over on X that I thought when it came down to around 54.60 was getting very interesting zone. And I just want to show you on the smaller timeframes. Let's look at it together. And we can have a look here. And what you'll notice is that the market kind of found a little bit of buying pressure, but never created much structure. Now, if it did this and then it breached up, that would have been an excellent trade for the session. But that's not what happened. So when we look at this underneath the hood, you're kind of saying, well, we need to at least get above this most traded zone of 54.70 to really find the buyers back again in the market. At the moment, it's just kind of like hovering around. There might be a great day trade over the next 24 hours, but more structure needs to be created. So really the bears are in control. And the level that I'm really interested in has to be 54.40. Take a look at this 0 DTE option expiration GEX profile. Basically, we have negative gamma coming through. We're underneath the big options that are sitting here. The puts are everywhere. And if we continue to lay underneath there, it creates that waterfall or cascade effect that we've seen so many times on the upside this year in positive gamma, which can really push this market down. And next stop would be probably around that 53.50. So this is very negative. We need to hold above 54.40 if you're a bull. And it's the same thing when you look at the 26. So if the market does find bid, I would expect 54.40 to be one of the big battle zones to hold up above. And you'll notice this is kind of consistent through the next couple of trade sessions. What about CTAs? Well, we've been talking about how CTAs were dumping positions specifically in the NASDAQ, that huge crush last week. And that was a warning sign for sure, along with the dark pool activity, and it led into being kind of correct. Gold CTA is still looking pretty bullish. Copper CTAs are looking absolutely horrendous. They're selling off across the board. And basically, we now have huge moves as well in the Brent market. Now, I think this is just playing catch up. So I'm still very interested in oil at this price. I think there could be an excellent day trade. And we've been looking for this one a little bit together. And let's move over now to some of the stocks we're all talking about. Tesla, bad-ish earnings. Overall market, of course, went super negative. Pushed down into 216. You'll notice by the end of the week, there's a lot of 220 puts now in the markets. So again, in a negative gamma formation, it may get lower. Maybe it crushes itself into 210 or 205 or even 200, which is where the 61.8 fib is. But this is now becoming a bit of a put wall. So markets may try to find structure and hold this zone. Again, I think you should be looking for structure. This is what we always talk about on the channel. Patience, react, don't predict. If you want to buy the dip because you're investing in it, that's a little bit different. But if you're trying to trade, it's all about creating a replicable strategy. Let's move over to NVDA now. And NVDA was, again, pretty wild. Now, I think focusing on around negative 20% return. And this is exactly what we thought would happen to semis. We knew they were in for a couple of rough months. It was not only seasonality-wise, but also they had all those signs of a bit of a slowdown after having such a huge rally and so much kind of fever around them, suck in the retail traders like you and I, and then, of course, dump the position into us. Now, 115, we've long suspected this is a huge level for puts. It still is this week, and I still think the 10 or kind of like 110 level and 115 are very key zones. I like them a lot for NVIDIA, and as you'll see in semiconductors soon, it's starting to look a little bit better, even though they're getting crushed into these zones. The VIX, this is big. Of course, big dark pool activity happened here. It led up, but it still isn't above 20. So we haven't really reached even what I would call medium fear yet. And the VIX above 20 is when often people say the bears are in control. But as you know, with any significant pullback, such as the October one of last year, or even the April one of this year, generally you'll get a VIX over 20. We haven't seen that yet, which suggests there could be more downside to come in the future. High yield junk bonds still look pretty good, a little bit down here on the week, but overall still pretty strong. KRE looking very good still on the weekly, and you can see the last 5 days, all right, it's been up, down, and all around, but realistically having a bit of a breather, beautiful move off the deregulation concepts. Home builders is the same. It made a new high, and yes, it's rejecting a little, but still very, very strong. So I think underneath the hood, some of the most important sensitive kind of markets are still doing quite well. The real discussion then becomes about yield uninversion and where yields are going. But I've noticed pretty much for quite a few days now, the US 2-year yield is dropping more, while the 10-year, you'll notice, is holding and hovering, which is causing that uninversion of yield curve, which will be something that really puts us on a timer, especially if we believe this is late cycle investing and we're going to continue to see strength in these markets. Copper, terrible, totally oversold, but at the same time, no bid. Just hit the 75 fib, one of my favorites. It's now in the secondary demand zone after getting crushed through the 61.8. I am looking for copper to find a bid, but it's no bid just yet. What about the US dollar? Well, some day traders might be trying to short it off in there. It did actually take the low of 103.89, rally up a little bit, and it's kind of weak around here. So even during a day of selling across the board in the markets, dollar could not find a bid. And that just shows you that what the power of these supposed rate cuts that are coming will end up doing to the dollar. I think it's going to begin a bit of a negative effect on the US dollar. Usually it would be markets down, you'd expect the dollar to go up. That is not the story right now. And it's actually, at the time of this recording, kind of where a day trader would try to short it and then put stops above here and obviously look towards weakness in the dollar moving forward. Let's move over to silver. Terrible hold. The tweezer did not hold. The tweezer did not break this high here. And you can see I've got first major bull zone. It's ripping through it like butter. No bid yet, but that's why we find the zones. We have patience for structure. And then we've got the second major bull zone, which is sitting here down at 26.50. Now, I really like 26.50 for silver if it can happen. But yeah, big wipe there of the lows. Interesting to see how the weekly closes. Gold, therefore, did have a rally through a lot of the session time. It was actually up about 0.7%. Our idea yesterday was to see this thing bull from here. And it did for quite a while, hit into this really small supply, and then nothing was safe in the market really, and it just kind of fell off. So a bit unfortunate there. I still think it was a pretty key zone, and obviously for a while it was in a bit of profit. But while the market started to get more and more hit, gold started to fall through. And while I'm very bullish on gold, of course, we've talked about $3,000 an ounce quite a few times. I'm looking for it now come down to $23.57 and then find some structure. Very negative daily session coming off that weekly, which looks like this, the shooting star. A lot of people are going to be saying this is a Wyckoff distribution. I'm not won over by that yet. I am still looking for bids, but I want a good swing bid, and we don't have a good swing bid yet. That was more of a scalp day trade. Went well for a while, then maybe could have broken even it, or the position is the position. Let's move over to the US oil trade or concept. Still no structure build. We're starting, well, structure is building, but still no activation. Close above 79.20, I believe, is bullish for oil, and it's sitting at a 61.8 fib retracement. And energy stocks, while they're down, they're not down that bad. So they ended actually flat on the session. So yeah, long leg doji, looking for a bid to come back in on XLE. Let's move over now to Tesla. As we've mentioned, gap fill seems kind of inevitable. It hasn't actually gap filled even to the wick, and certainly hasn't come back to the 61.8 fib yet. So I kind of think there's more to go on Tesla to the downside. That being said, it could find like a little bit of a dead cat bounce and then go hit the 20 and then maybe fall off. But yeah, quite negative here and still looking towards these levels. And this is what happens when you get those breaks. A lot of people will take the range. So this is the range here. And what they'll do is they'll extrapolate that out. And if that kind of prices in correctly, then usually you're saying that market proofs itself. So let's just put this on the high, and you can see it proofs pretty nicely. So it suggests that there might be a little bit more downside to come on Tesla. Google, I just thought I'd leave this in here because I said yesterday I kind of wanted to see around a 173 to even consider structure. I do love Google. I think the stock is quite good at the moment. And it came down to the first interesting bull zone, No bid yet, but if we do start to see bid off this, that will be very strong. Big volumes, of course, coming through so many of these stocks. Let's now take a look at NVIDIA because it fell off and it made a new low and it's not at the 109.44 zone yet. It obviously closed to the lows. I'd like to see it kind of drop further before it gets a big buy. I'd like to see it around here. And really what we're looking for on semiconductors is movements down to anchored VWAPs and the 20 weekly moving average. Now, if you look at semiconductors, it actually just hit the weekly 20 moving average, or it's really close to it. So across the board, rather other than NVIDIA, semiconductors have actually fallen what you would expect them to do. And around this 20 weekly moving average has not been the worst by the dip strat over the last kind of year. This is a very key level, and we haven't got a bid here yet. We'll be looking for structure underneath, but this is exactly kind of what we expected. And if you have a look at semiconductors versus SPY, it's also sitting around what we expected, which has been a very consistent kind of run. So will this be the one that breaks it? I'm not sure yet. It's closing on the lows. You usually want to see a turnaround bid, and we'll find out whether that happens. Chinese stocks, bad, of course. If the rest of the market's not doing well, then the Chinese market's probably not going to be doing super well either. And HSI got crushed back down. So it's almost at the 75, which is kind of the worst case scenario of this last run. I would like to see a bid on this. We'll see whether it happens. And for now, it's almost more interesting to look back to the US markets, considering some of the potential, inverted commas, deals we're starting to see on the big tech. They are getting discounted across the board. Okay, let's move over to one other market I thought was worth mentioning, which is the UK 100. It fell just into this kind of wick zone. It's still structuring through this area. So what that's doing is it's kind of telling you that it's, again, not a broad-based sell-off. Have a look here at different feeds, and you'll notice the UK 100 still holding up. And this, along with IWM, is really telling us that the market is not broadly selling off. It's really concentrated into the bigger tech. Speaking of big tech, let's have a look at the Qs. Falling after our read a few weeks ago that said that all was not so well. And it is now down from top to bottom in correction phase, almost 8.5%. Now, we kind of expected 10 from this market, and that would put us in around 18,500. Let's have a look at the smaller time frame. I've got an interesting turn zone marked here based on this really small order block on the left-hand side. And look, we haven't got structure bid yet, but day traders will need to watch this level. Similar to what we talked about with the S&P 500 when it was at 5460, guys. If that had structured up, it could have been a great little day trade for a dead cat bounce. At the moment, the market is, of course, crushing down, but I could see a potential turn here. I would prefer to see it in 18,500. And as always, I do pay more attention to the S&P versus the NASDAQ. If you can have a look also, we check out the evening star pattern that's formed, which is a pretty negative overall sign. And that's, of course, leading into further weakness. So 18.5, yeah, 550, certainly something we're looking at. What about the Russell? Well, the Russell sold that level where we saw the big trades come in over the last 24 hours, but it's much stronger. I mean, the Russell has not suffered anywhere near the fate of the rest of the market. So to be expected because we're seeing that rotation occur and particularly KRE hold up, but interesting nonetheless. This is proving that it's not a broad-based asset sell-off yet, and we don't necessarily need to be absolutely terrified of this market. What about Bitcoin? Well, it was doing well like gold for a lot of the session. Then it started to fall, and it came back down to this bull swing zone. So this is the 20-day moving average. And are there any bid levels yet? No. Is it a point of interest? Yes. Should we be getting onto the smaller timeframes here? I'd say yes, and having a look. And of course, day traders will want to pay attention. These are all theoretical, decent turn levels. For something like Bitcoin, this is only just the beginning, though, of what could become a little bit more of a sell-off, even though I'm very bullish on it. Because if you notice, it hasn't even done a 38.2 off the whole low, and this is a 38.2 of the last swing. So that is also key. And I thought I'd just mention while I'm thinking about these swings, the US 500. So one of the things I was playing with today is if we took the top to the low, and then we extrapolated that out, and we considered this a leg, often Elliott wave traders do this, you'll notice the leg goes right into that trend line at around 5,400. So it actually legs straight in there. Now, this also is consistent when we use a fib-based trend extension tool. So if we have a look here, a fib-based trend extension will actually sit at about a 1 around there, plus an anchored VWAP, plus the trend line. And what I'd love to see is like a pull down, a wick through, either going to 5,300 and a wick through, and that would show us that yes, the buy the dip is in play. So remember, if you're interested in finding out more about what these key levels will be, subscribe to the channel. Core news is really core PCE coming out and advanced GDP on Thursday, but really it's core PCE. And of course, we have earnings season still going. If you enjoyed today's video, then remember to check out some of our other stuff. Follow us over on X. And if you're interested in finding out more about how you can replicate certain trades and join us in the community, then you can check out our Market Masters Club. We do live streams for the opens and closes. And of course, we also have some amazing courses that create replication in times like this. Thanks so much, guys. We'll see you in the next one. Bye for now.